All right, folks. It is Friday afternoon. We're here on Westward Drive, Miami Springs. We're going to come visit a friend. So, as you know, across the street, we got the Leonard Real Estate Group. We're here on Westward Drive and Park Street, right across from City Hall. So here you see our police department. There's the Women's Club. There's the Leonard Real Estate Group. But we're going to come visit a friend here at Firenze Group Mortgage. We're going to walk in and say hi. So again, right across from the police headquarters and the fire rescue is Firenze Group Mortgage Services. So we're going to come on in and say hi to Aldo. So join me again. The address here is at 299 Park Street. So let's walk in. All right, Aldo.
Hey, mister.
How you doing?
Doing good. Good to see you.
Thank you for inviting us in. How long have you been operating Firenze Group Mortgage?
So we've been actually.
All right. Hey, Aldo, we're back. I'm sorry about the buffering there while we were live streaming here. So you got the, we're here in your conference room. So we were just asking, how long have you been here in the mortgage industry?
Yes, well, I actually been in the mortgage industry since 1994, but I've been working on my own since August 10th of 1995.
All right, and so obviously you can have your business anywhere. Why decide to offer mortgage services right here in Miami Springs?
Well, actually, my father-in-law had an office here since like 1961. So when it came time to open up my own business. It was easier just to come over here. And then once we found out about the community, the people, it's there's actually no better place.
It is a fantastic. We're homers. We're partial here, but we agree with you that there is no better place than here in Miami Springs. So, obviously you're an expert in this field, and there's been a lot of changes that are happening in the mortgages. Rates have gone up. So. You've been here, in this for a long time. So tell us, put in perspective, what's going on with mortgage rates and what lies in the future?
Well, what happens is I guess bad news sells.
Okay.
And so everybody's talking about how the rates are so high, and how it's so much more expensive to want to own a home nowadays. Prior to 2003, the rates had not been under 5% for 40 years. So if you're taking a look at the rates the way they were maybe a year ago, 2 years ago,
right,
that was the lowest that they had ever been in the history of the United States. It was basically not the norm. You could actually get rates under 2% on a 15-year fix, but that had never happened ever before in the history of the United States. Now the rates are, they're in the fives. And in terms of the fives, it's, still something that's very affordable.
So the interest rates right now are still, relatively speaking, low. So in, let's say, the last 20 to 30 years, what was the high?
So actually, going back in the last 20 years, it only went above 5% a couple of times, and in terms of the height, it went into the sixes.
Right.
Not looking back in the last year, because in last year the rates actually went all the way up to 7%.
Okay.
And they were talking about the rates going higher and higher and higher, and actually that didn't happen. People confuse, and they think that when the feds change the rates that they're actually changing the mortgage rate, and that is not true.
Okay.
It has an indirect impact. The treasury bills is what changes the rates. It's based on the treasury.
Okay.
And so what happens, there's a lot of factors that affect the interest rates, and I've seen where the feds have actually increased rates and mortgage rates have gone down.
That's wild.
Yes.
So right now, well, going back in terms of a little bit of history, I know that rates had kind of skyrocketed in the late 70s and early 80s. What was the high point in that era?
Well, actually, I'm going to tell you, I wasn't in the business back then.
Okay.
From what I hear, it went up to like 18%, which was, was ridiculous.
Okay.
But also the prices were a lot less.
Got it. So obviously we're not at those crazy highs. We're not anywhere, double digits or anything like that. So let's say someone, and I don't even know what a typical mortgage is today because prices have gone up, through the roof.
Right.
For you, what do you see? What's a typical mortgage that people are applying for in terms of like the loan amount and interest rates that they're getting, if you don't mind.
So yeah, most of the times, it all depends, whether they're a first-time home buyer or
Right.
somebody, who's, sold their house, because somebody anybody who's owned real estate, even though the prices have gone up, sort of the price of the property they own. So if they were able to sell the property and net out a good amount of liquidity from their asset,
Right.
they're able to put that and turn around and put it as a down payment. So if you're looking as a first-time home buyer, you're probably looking it ranges around 600,000. People putting 5% down, and then what happens is people put a lot of impact or a lot of importance in the interest rate. And the interest rate is super important, but one of the things that's also very important is the insurance.
Okay.
And sometimes when you're able to go and shop and get a really good premium on your insurance, you may be able to keep your monthly payment down.
Okay, and you're talking about the mortgage insurance or property insurance?
No, property insurance. Property insurance is huge.
Yeah. So you're saying, hey, there's opportunity here, to negotiate down your property insurance to save on your monthly bill, maybe more of a savings than necessarily the interest rate.
Well, yeah, absolutely. Like what happens is another thing also people don't consider. Every time they're shopping interest rate, closing costs, mortgage terms.
Right.
But one of the things they don't realize, it depends what institution you're going with. They may have requirements that that put you in a place where you have to get a higher insurance coverage, which is going to make your premium higher. So sometimes people are concerned about maybe saving an eighth of a percent in interest rate, which could make a difference in a monthly payment of $40 a month. But then they're totally okay going and buying insurance is going to cost them $300 more a month, which makes no sense.
Okay. Now you make me paranoid. Like, okay, I gotta go back home and go check out my insurance policy, see if I can save some money.
Yeah, you could. Absolutely. That's one of the things you could do.
But in your world, you're not selling insurance. Just to be clear to people, you're not selling insurance, but you do. And correct me if I say anything wrong here, but you're connecting people with the best mortgage package for them.
Yes. So what we do is like we're a boutique. We're not just interested in selling you a mortgage. What we're interested in doing is helping you out in terms of buying a home or refinancing and getting you the best possible deal. And one of the things that we will do is we will recommend you to different insurance companies that you can do business with. And the financing that we're able to obtain, we don't require you to get additional coverage in your insurance so you can keep your insurance premium down, because the requirements for insurance comes from the lender, from the institution. And if their requirements are higher, you're going to end up paying a higher insurance coverage.
Right. So even though they may not be collecting the monthly payments directly, the net effect to the customer is a drastic difference from one versus the other.
That is correct.
So we were talking about the typical new home buyer, and you say about $600,000, about 5% down. I'm doing the math in my head. Is that about $30,000 cash that you got to bring?
Yeah, that's that. Plus they have closing costs that they have to, consider.
Right.
So you're probably looking, somewhere around 3% in terms of closing costs. It can vary depending, because part of the closing cost is the insurance they have to pay up front in 1 year.
Right.
So you're looking, somebody who's looking to buy something for $600,000 are probably going to look somewhere around the $40-some thousand that they will need out of pocket to buy.
So $45,000 in cash out of pocket expenses.
That's correct.
To put down for someone who's trying to say, hey, how much do I have to save to buy a home at around $600,000? You're thinking about it.
Yes, somewhere in the 40s. But also, one of the things that we can do is a lot of times when people are coming and they're trying to, to buy or get a mortgage, they want me to tell them, like what's the best possible scenario, that I can offer them. And I like to do it a little bit different. What happens is I like to understand what position they're in. So like if I have a client that may not have, $40-some thousand to buy and only have 30, there's other ways and things you can do. You can, talk to the real estate agent, see if the real estate agent is able to negotiate a credit towards closing costs. In some cases, if you're able to negotiate that, they may be able to buy that with a $30,000 out of pocket.
Excellent. All right. So some of so you can help someone before they found a home to help negotiate, the right mortgage package, as well as maybe some tips to help them with the closing costs.
Well, so what we'll do is if I have an understanding of what position they're in, I'm going to let them know what they need to do to put themselves in the best position to be able to acquire a home today.
Got it. Okay. So now you not only help folks who are trying to get in their first home, but obviously a lot of people who want to either refinance, buy a second home, or maybe cash out some of the equity. Obviously, we talked about some of the values have gone through the roof, so there's the amount of equity may be surprising for a lot of people.
That is correct. And then basically, home financing is the cheapest way to get money. If you're trying to get like an equity line of credit, a lot of times those interest rates are adjustable, they're high. Business, loans are also more expensive, commercial loans. I mean, basically, one of the things that I'm very proud of is that we offer from beginning to end any kind of finance. We do commercial loans, we do lines of credits, we do business loans, we do, any kind of finance. If we can't do it, it's just not possible to be done.
Got it. So, and like you said, you're a boutique, so you work with different lenders, different loan packages. So, the client can come to you in terms of, hey, look, the typical customer doesn't, do this on a day-to-day. They may do. How often does a customer, mortgage a home? How often does that happen?
Normally they buy a home every 7 years. So let's say they refinance it. Most of the times, within 7 years, they may do a mortgage 2 times, if that.
Right. So let's say for our Miami Springs audience here, the typical Miami Springs home value has increased. I don't know. Tremendously, right? Mm-hmm. How much equity does typical, let's say, I don't know, let's say a 3-2 that would have been 10, 15 years ago, $400,000. What is that today? I
mean, as a 3-2, it all depends on obviously what condition it is. That that's not my level of expertise in terms of determining value. But what I would tell you is that easily could be 600, 700,000, or even more. And so what happens is most people that have not refinanced and cashed out, they have hundreds of thousands of dollars in equity, even if they bought the property just a few years ago.
So if someone needs cash right now, the answer is they probably have cash sitting in their home that can be utilized, whether it's for renovating their home, adding on some other business expense, business venture that they want to get into. What are you saying? What are people using that dollars for? What are they coming
some people are coming in, they're just cashing out, and they're buying other property, other investment properties. Like I had a client that came, cashed out, and went and bought a property cash, and they're looking to do Airbnb here in Miami Springs. Got it. One of the things I would tell you, like for me, I like to give, I'm not a salesperson, I like to give advice to my clients. So like if my client comes in and they're telling me they want to refinance, I want to make sure that they're really going to have a benefit by refinancing. There's many times that they come in and tell us, listen, I don't recommend you refinancing, better save money. Or I've had clients that want to refinance to lower the payments, and I recommend, listen, talk to your insurance agent and, see if you can change the coverage a little bit, reduce the yearly premium, and then they're able to save money and they don't need to refinance. So I don't want people to think that we're trying to push a refinance. We're going to do an analysis, a thorough analysis, and give our recommendation.
Awesome. So and that's one of the things I guess makes you different than a typical bank. A bank is just, by and large, it's a numbers game. They're trying to pump in as many applications as they can to get as many loans approved, etc. Here, you're more boutique. Helping the individual.
I've been doing this for 29 years. This is not just what I've been doing for the last 29 years. I actually have a master's in finance. Numbers is what I do. And, something that I learned at a very young age, in the business, is that if you give the right advice to a client's going to know, and then they're going to come back and they're going to recommend other people. So I definitely never want to have, a client do a refinance that they're not going to have a substantial benefit.
Got it. So if they're just thinking, hey, just to lower the payments, you may give them different advice, look at your insurance or some other things. But they're definitely, speaking with you is the right thing to do in terms of trying to get different options.
You got to take a look. It's like some people are looking, to refinance. They want to lower the payment, but they're telling me that they're going to be moving out of the state next year. Well, it makes no sense.
Right.
You're going to pay all these closing costs. You're going to save money in your monthly payment, but a year from now, you're going to be moving out, selling the property, and the majority of the closing costs that you spent, you're not going to be able to recuperate.
Got it. What, as far as, let's talk about new home buyers. The new home buyer who comes in with, let's to be frank with people, what type of credit should they have? Income, that they, and I know every case is different, but in terms of putting that new home buyer in the best possible position, what position should they be in?
So here's the thing, like I always recommend anybody who's looking to buy a property to speak to a mortgage professional that, you know, that can give them advice to put them in the best position. So it all depends on where the client is, and it all depends on the programs. Like you can actually have a low credit score and not have perfect credit and still be able to get financing. Now, my job and the job of our company is to get you the best possible interest rate. So one of the services that we do right here, we analyze their credit, and if we see the possibility where they can increase their credit, we do what is called a rescore. So we do an analysis that tells us different things that they can do to improve their credit, and by doing that analysis and by them doing what we're telling them to do, we can actually increase their credit within a week. So it's not something that they have to wait 30 days or 2 months to be able to do.
Right.
It's a free service that we offer, and any time that we have a client that can have their credit be improved a little bit, which is going to get them a better deal, we actually do that. We'll go ahead, even if we have a client that has good credit, say you have a client that has a 738 credit, which is really good credit, but at 740, they're going to get a better interest rate, and then we're going to go through the process of increasing their credit and put them at a 740.
Now, I don't know that the banks do that.
No, they don't.
Something different that you guys do that a typical bank won't do.
What happens is, you know, banks and mortgage companies are trying to take as much business as possible, so they don't have the time to do those analysis. As a matter of fact, I actually started the business back in 1994 with Citibank, and we used to have quotas that we used to have to take 8 mortgage applications a month. And I remember my supervisor telling me, listen, you want to take, you know, as many applications as you can, because you're going to have between a 30 to 40% fallout. So what I would tell you, to me, that makes no sense. If you're turning down 30 to 40% of your business that's coming in and you're not able to help them, it's not a very good reputation. And that is the number one reason why within 12 months I opened up my own mortgage company. And, you know, during the pandemic, actually, you know, during the pandemic, things changed. It got a little bit tighter. You know, now things are, you know, back to normal. But prior to the pandemic, in 5 years, when it came to denying clients based on their income, based on their credit, based on their personal situation, we only had 2 denials. I'm not saying that we only, and that's in a 5-year period, because we're very thorough in the analysis we do. We had actually more denials, but it wasn't related to the client. It was related to the information that we didn't have access to, like value, or we've had, you know, scenarios where people bought properties that weren't insurable because it wasn't in good condition. That has nothing to do with a mortgage. But when it came to the actual clients, you know, financials, we had 2 denials. And I would tell you, I don't know of any other institution that can say that. Our neighboring bank will deny 2 transactions a week, yet alone in 5 years.
My goodness. So, you know, for someone who's out there, you're going to walk them through their personal situation and be very frank with them in terms of, look, you can qualify for this, you can qualify for this. These are the different options and programs. And the reality is you have access to programs that the regular customer probably would never see.
Yeah, well, not only, you know, access to programs, but we will structure the loan in the best possible scenario. So, I mean, we're like experts in the loan structuring. And
the typical customer, say a new home buyer comes to you, are they looking still like, is it a 30-year, or are they trying to get it more of a 20-year or 15-year? So
it all depends. You know, here's the scenario. Like a lot of times people are going out there trying to buy the biggest house that they can afford. And so when you get into that position, you want to recommend the client to go with a 30-year mortgage because 2 reasons. Number one, it's easier to qualify, and number 2, you don't want to have a monthly payment where they're going to be struggling. But I'm going to give you guys a recommendation. Sometimes it's better to tighten that belt and, you know, get a 50-year mortgage, because when you get a 30-year mortgage, as a rule of thumb, the first 15 years, you're going to pay 18% towards your principal. So that means you're paying 82% of your payments are going to interest. And the next 15 years, so, you know, if you get a 15-year mortgage, 100% of the payment, actually, you're going to pay 100% of the principal. So it doesn't mean that by going from a 30 to 15-year mortgage, your monthly payment's going to double. Sometimes it could be, you know, just paying $700 more a month. You're going to eliminate 15 years of mortgage payments. So if you're paying $700 more a month to eliminate 15 years of paying $3,000 a month, you're going to save a ton of money.
And that's huge for anyone. So the main takeaway here, folks, is that they can come down here and match the individual or the family with the different options that are applicable to them, and give them the options that either will save them the most money or that will lower the immediate monthly payment. So whichever option is best, more palatable to that client, you can connect them to the right mortgage package or the right plan that works for them.
That's correct. Like one of the things that that I'm very proud of. I don't consider myself a salesperson. I give advice. I give so like somebody comes in, I'm going to do an analysis, or my team is going to do an analysis, and we're going to see what's the best scenario for them. Once we see that, we're going to give a recommendation, but we're not trying to sell you something. We're not trying to push you to do something you don't want to do. And the other thing also, we're like doctors. You're coming in, you're telling me where your pain is.
Right.
So if you're having stomach pains, we're not giving you, aspirin for, for a headache. So we need to determine what you're trying to accomplish, and then we're going to, find the best way for you to accomplish your goal.
So you get a full gamut of clients. I talked a little bit about new home buyers, but tell us some of the kind of different scenarios from obviously we talked about the new home buyer, but what are some of the different scenarios that you see, or some of the different strange cases that you get that you're able to help people out?
So I'm gonna say like the most common one are the people that are self-employed. They come to me, they're like, I made a ton of money. I have no problems in qualifying. I actually had a client just the other day looking to buy $1 million property,
right?
And they were telling me, my income is super good. I make a ton of money, and I look at their income, and they're making $84,000 a year.
Right.
And I'm not going to say that $84,000 a year is not good income,
right,
but it's not enough to buy $1 million home. And so what happens is, people don't understand that there's actually three types of income. Okay. One of the incomes that I say is the income that you actually earn is the money you put in your pocket. So when you bring home every single, month in income, that's your income. But then there's the income for the IRS.
Right.
So what happens? That's the income that the IRS says that you made and what you're going to pay taxes on. And then there's a third type of income, which is the income that you're going to use to qualify for a mortgage. There's a law that came out that you have to determine when you're buying a primary residency, you have to determine the ability to repay the loan. So if you don't have the ability to repay the loan, they're not supposed to give you a loan.
Right.
So when somebody is self-employed, we have to do what is called a self-employed income analysis and determine what the income is. And it's not just as simple as looking at tax return and looking, at the bottom of the page, at the first page of tax return, determine the income. Right. You have to add certain numbers, deduct others, and then at the end of the day, we're going to have an income that's completely different than what you reported to the IRS in terms, that you're paying taxes, and also completely different of what you're depositing in your bank every single month.
Got it.
So what happens is we have programs for that. We have what's called a bank statement program, where we will take 12 months of their bank statements, either business bank statements or personal bank statements, and we will determine which deposits are related to your income, and we will count that, the average of those 12 months, we'll count that as income.
So interesting. So someone you can really help that person that's self-employed, has an LLC or an S corp, and you come in and say, look, this is what I report to the IRS, but really, the business has been doing well. Help me with this, large property and trying to purchase.
Yeah, so that's one program. Another program that we have is called the Investor Cash Flow, where if you're buying an investment property, you do not need to show the ability to repay as an investment. They figure if you own your home right now and you're buying investment properties, you're savvy in terms of what you can afford or not. So through the Investor Cash Flow program, we will use the rental income or the potential rental income to use that to cover the monthly obligation in your mortgage. So that's another way. We also have the private loans, or where it's private people that are lending money. Right. I have like the no income verification of any kind, but all these loans are more for investors, not for people that are buying their first home or a home that they're going to live in.
Got it. So you have a wide variety of different options, different scenarios that people can run into, and obviously more than what I can come up with in my head. But it sounds like it's an incredible opportunity for someone who's in a different financial situation to come and speak with someone like you who would coordinate their specific situation with all the different options that are available to them. Now, I wanted to get back to the investor type, right? So someone who can use say they want to buy, they have some money and they want to go ahead and buy an investment property, and just for a round number, let's say it's a $500,000 property, and maybe they got. I guess the question is, how much would they need to put down to buy like a $500,000 property? And I know it's a tough question without
it is a tough question, because what happens is, and I get those questions a lot. It changes from program to program. I mean, we got to take a look at the credit score. We got to take a look at the type of property that they're buying, whether they're buying a condo, they're buying a single family home, or they're buying a 5-unit property. So it changes. But typically, when you're buying an investment property, they want you to put a minimum of 20% down.
Got it.
In some cases, you are able to do a 50% down, but it gets too expensive. That's one of the things that we want to take a look into. Is if sometimes you could just put a little bit more money down, and you're going to save a lot of money either in the monthly payment or the closing costs. It's just a better scenario for the client.
But so taking your advice of the 20% rule, so someone who wanted to buy a $500,000 property could use the income of the rental to help show that they have
That's correct.
to cover the rent, but should probably come down with about $100,000 down.
Yeah, they could do that. And the other thing also, people make assumptions in terms of what makes sense or doesn't, and when it comes to the finance world, what makes common sense to you, it's not really common sense. We don't use that kind of common sense. So what happens is, sometimes it's easier to be able to buy an investment property than it is your prime residency. So let's say that somebody goes and buys a prime residency and they qualify and they can get a loan, but let's say their ratios are super tight because their income, they can barely afford it.
Right.
And now they want to buy a second home, and they're going to be discouraged. No, I can't buy a second home. Nobody's going to give me a loan. And they would be mistaken. Because what happens is, when you buy a property under, let's say the best interest rates and the best programs out there in the market, they're going to use 75% of the rental income or the market rental income to help you qualify to cover the payment. So let's say that you're buying a property where the rental income is $3,000 a month and your mortgage payment is going to be $2,250. If they use 75% of the $3,000, it's exactly $2,250. So meaning that person has zero additional debt because the rental income is going to cover their entire mortgage payments, and so they don't need to have additional income to qualify. So they would be able to buy a second home, or not second home, but an investment property.
An investment property.
Yeah.
They'll definitely need that initial down payment.
Yes.
They'll have to have that, but they don't necessarily need the extra income to qualify. That's
because
great.
You have the rental income, and actually with that, because the investor cash flow is a little bit riskier loan, so the rates are a little bit higher.
Right.
With this one, the rates would not be higher. They would be your typical investment loans for Fannie Freddie type loans.
So Aldo, you cover a lot, and obviously you can go well into this in terms of all the details. But I want to look at a little bit in the future as much as you can. I know no one can predict the future, but obviously, so interest rates, went up, and I know there's an indirect effect of the Fed rates, but the interest rates have gone up. Just to let people know, where are interest rates on the typical mortgage at right now?
So yeah, that's it all depends on what kind of program, but
Right.
Somebody that has good income, good qualifications, something you can get interest rates in the 5s. I remember when I started business in the 90s, we used to get faxes of the rates.
Yeah.
Right? And so what happens is whether you had a 620 credit score or you had a 760 credit score, you got exactly the same interest rate.
Interesting.
It's no longer the case.
Yeah.
So what happens is we don't look at rate sheets anymore. Before we used to look at rate sheets. Now you put the client's information into a computer, and the computer comes back and gives you all the different rate options. The reason being, also some of the things people don't think about. Somebody borrowing $100,000 that has perfect everything is going to pay a higher interest rate than that same client borrowing $500,000 on a loan. $500,000 in a loan, because what happens is banks don't like doing little loans. So what they do, there's going to be a little bit of a premium. So we need to determine that. Are you borrowing $100,000? Or Are you borrowing 200?
Right.
Are you borrowing 800,000? So there's a lot of factors that affect it, and so it's hard to determine in terms where you would be.
Got it. Well, again, another reason why they should come down and sit down with you and your team and figure out what their situation is and what are the different options for them. So if the rates are right now at 5, again, putting that crystal ball, what do you see?
So I really, that's a really tough question. I'm gonna tell you why. People love to talk. If you I don't know if you're into sports, but if you're into sports, people are saying, what, this team's the best team, and this team is going to win the Super Bowl, or this team is, going to win the NBA championship. And sometimes it happens, but a lot of times it doesn't.
Right.
So it's the same thing in, in our industry. People like to predict where we're going to go. And I'm going to tell you something. It's easier to predict where we're going to go, but it's so hard to predict when it's going to happen. So I expect the rates that the rates are going to go down. But when are the rates going to go down? Are they going to go down, in 6 months, a year, 2 years? And anybody who thinks that they know what's going to happen, my recommendation would be start investing in futures and options. You could retire. Right. Nobody really knows exactly.
Okay, but so right now you're not expecting any major rate hikes, is what I'm hearing.
No.
Okay, so you're not expecting any major rate hikes. At the end of the day, if someone does get a mortgage with you, let's say in a couple of years there's a drop, they can always come back and refinance at a lower rate.
Yeah, you could do that, but you got to be very careful. And a lot of times, people don't do this analysis, but anytime that you want to do a refinance, there's going to be closing costs, just the same way you have to pay closing costs when you purchase a property.
Right.
And I have a formula that determines how quickly they're going to be able to recuperate those closing costs. So if you have a person who's going to refinance and it's going to take them 5 years to recuperate the closing costs, it may not be worth it because they may not be in the property 5 years from now. So that's something we have to determine. The rule of thumb, I want to make sure that a client can recuperate their costs within a 24-month period. So if they're going to refinance and they're going to be saving on the interest rate, and within 24 months they're going to recuperate the closing costs, and they're planning on staying in the property, long term, then something that's worth it. You don't want to go. You got to take a look and see the mixture in terms of savings, monthly savings, and what the cost is. Even though the cost is not going to come out of your pocket, they're going to increase your loan amount. So what happens is when it's time to sell that property, you're going to owe more money if you haven't recuperated your closing costs.
And folks, again, another reason why you should come down here and meet with Aldo, who will take a look at your situation and give you the right information to your specific case. So, Aldo, for those people who do want to reach out to you, what's the best way for them to get a hold of you?
I'm going to say, listen, I'm old-fashioned. We have a phone system here that we pay a lot of money for, but the best way is to get a hold of me through my cell. Okay. Which is 305-498-1468.
305-498?
1468.
1468. Okay, that's his direct line, folks. So if you want to give him a call or text him, this is Aldo here at Firenze Group Mortgage, and he can help you out. What's your website?
Oh, that's a good one. I believe, because I don't go on that website a lot, I believe it's Firenze Group Mortgage.com.
Just Google Firenze Group or just go to MiamiSprings.com. We have the link right there. You can click on the banner and go to Firenze Group's website. And, for someone who's starting out or they want to refinance, to prep them to come meet you, what kind of paperwork, what should they have set together to come and set their meeting with you?
So what happens is it changes from person to person. My recommendation is to give me a call. I'll just spend 2 to 5 minutes doing an analysis. There's no cost for that analysis, and I'll be able to determine what documentation I need to see.
Perfect. All right, guys, you know the phone number to call. Here's the man to call if you need to refinance, want to purchase your first home, or have a unique financial situation, have a business, need to get some kind of access to cash. The gentleman to speak with who will not just try to get your application just to be a numbers game, but who really will genuinely try to help you is Aldo here with Firenze Group Mortgage, and give him a call to help you out. Aldo, we really appreciate you inviting us into your office, and look forward to doing this again.
Thank you, Nestor.
Thank you.